Hello everyone, I'm Hiro. Today I want to show you the composition and function of basics of candlestick in foreign exchange trading. What is the candlestick? A candlestick originated in Japan. It's early in order to record the fluctuation of rice prices. Later, for the financial sector, such as stocks, futures, and foreign exchange. That is the candlestick. Now, let's see how a candlestick is formed. This part is the upper shadow line. And this section is lower shadow line. This is entity, real body. This is a bullish candlestick. This is the same upper shadow line, lower shadow line, body. It's a bearish candlestick. Look, this is a bullish candlestick. This is open. Corresponds to the open price of the candlestick. Open price here. The market begins here, open, and goes up to the high, corresponds to the highest price there, and then go down to the low, corresponds to the lowest price there, and then go up and close, corresponds to a close price. The body. The bullish candlestick indicates a rise, open here, close there, a rise. A rise. Look at this chart. This is a bearish candlestick. Open here corresponds to open prices there. And then go down and go up to the high, the highest price there. And then go down to the low, the lowest price here. And then go up, close here, close price. This is body. The bearish candlestick indicates a down, open and go down and close here. Go down. Well, let's have a look. This is a Yang Marubozu line. Yang Marubozu line. Marubozu line is the name of Japanese candlesticks formation used in technical analysis to indicate a price has traded strongly in one direction throughout the session and closed at its high or low price of the day, like this. The Yang Marubozu line open at the lowest point, open at the lowest point, and close at the highest point, and close at highest point, indicating that the upward trend, indicating that the upward trend is very strong. Conversely, in Marubozu line, opened at highest point, and closed at the lowest point, indicating a strong downward trend. These two are called hammer lines. Because it looks like a hammer. Hammer is a bearish candlestick pattern that forms at the end of an uptrend. Generally, the large sales off is seen as an early indication that the bulls, that means buyers, are losing control and the decline is about to begin. It's an inverted hammer line. The inverted hammer line is a type of candlestick pattern found after a downtrend and is usually taken to be a trend reversal signal. The inverted hammer looks like an upside-down version of the hammer candlestick pattern, and is also called shooting star. This is a small yang line, small yin line, cross line, inverted cross line, T-shaped line, inverted T-shaped line, gravestone doji. A gravestone doji is a type of candlestick pattern that is formed when the opening and closing price are equal and occur at the low of the day. A long upper shadow suggests that the day's buying pressure was countered by the sellers and the force of the supply and demand are nearing the balance. This pattern is commonly used to suggest that the direction of the trend may be nearing the major turning point. It is also called the inverted T-shaped line. Cross-start doji. The doji is a commonly found pattern in the candlestick chart of technical analysis. Now, let's have a look. Combination of candlestick. Bullish engulfing pattern. A bullish engulfing is a chart pattern that forms when a yin line is followed by a large yang line that completely eclipses or engulf the previous candlestick. The shadows or tails of the small candlestick are short, which enables the body of the large candlestick to cover the entire candlestick from the previous bar. A yin line is followed by a large yang line. A yin line is followed by a large yang line that completely eclipses or engulfs the previous bar. That means that this is the signal that market will go up. Let's look at this chart. Bearish engulfing pattern. A bearish engulfing is a chart pattern that consists of a yang line is followed by a large yin line that completely eclipses or engulfs the previous candlestick. A yang line, this is yang line, is followed by a yin line, usually a long yin line, that completely eclipses or engulfs the previous candlestick. That means that this pattern indicates the market, the trend will go down. The combination of a Morningstar reversal pattern is that the bearish candle stick, usually making a new lows, is followed by a yang line on the right. Among them, there is a cross or hammer, and so on. Yin line on the left and yang line on the right. Among them, there is a cross or hammer. Of course, if this candlestick is yang line, yang cross line, that's better. This signal indicates that the trend of the market will go up. So at this point, you will go long. You will place an order to go long. An evening star reversal pattern consists of a yang line on the left and a yin line on the right. Among them, there is a cross or hammer. Yang line on the left, yin line, usually long yin line on the right. Among them, there is a cross or hammer. The candlestick is yin line at this moment. It's better. This signal usually indicates that the trend of market will go down. And you can place an order to go short, or going short. Because at this moment, the bulls do not push the price much higher. The following is a note. The first, to determine the accuracy of the market by using the candlestick is not 100%. Second, the candlestick is not enough to judge market as an analytic method and to be worked with other indicators to improve the accuracy rate. Third, location for the candlestick is very important. Candle chart is not the unique indicator to judge the foreign exchange market, but it will play a great role to learn and use it well. In future videos, we will further elaborate usage of candlestick according to other indicators and market conditions. Today's video comes to an end, and see you next time.